welcome for today's interaction. I'm joined by my colleague Chirag from Mumbai, and we have with us Ankit Jain, fund manager at Mirae Asset Mutual Fund. Welcome, Ankit.
Yeah, hi. Yeah, thank you.
So, Ankit, you started your journey at Mirae Mutual Fund as a research analyst in 2015. And it was in 2019 that you started managing the Mirae Asset Blue Chip Fund. So, how does that experience of being a research analyst help you manage funds? As in, what were the key lessons that you learned during that period?
Yeah, hi. No, absolutely. So, so my journey in Mirae, as you rightly mentioned, started in 2015. As a research analyst, tracking mid and small cap sector. Then obviously started tracking some of the mainstream sector, autos, consumer. And then we have got one this interesting product, which is thematic product, Great Consumer Fund. So that was the first product from the fund management standpoint came my way in October 2016. So in that sense, I think it's been now almost 7 years since I started into the fund management space. But then obviously, since I've been tracking mid and small cap research for my earlier part of my career and even within Mirae. So naturally, I think mid cap mandate was the natural sort of a choice for me. So I think that is how I started getting involved in mid cap mandates, certain offshore mandates. And then domestic mid cap mandate also happened around 4 years back plus. And then this flagship product which you talked about, emerging blue chip, which is also is a good combination of large and mid cap products. So I think it is all about, I think your ability to identify businesses, try to forecast, I think their ability to generate growth, cash flows in the future, and then try to discount it to really arrive at a business value. So I think it is all about bottom-up stock selection through the different set processes, which has been laid out, and try to follow those processes across the cycle. I think that remains the key sort of a learning. As I move forward from, let's say, research analyst role to the fund management role, and I think that basically still, still continues. Yeah.
Okay. All right. And can you explain your investment philosophy and your approach to managing equity portfolios now?
So investment philosophy is the three key part of it. To start with the business selection side of it. Second is management evaluation. And third is arriving at an intrinsic value of the business valuation side of it. So business selection side, India being a growing economy, first priority always about to invest in growth-oriented businesses. So which is about any business which has got longer term growth potential, at least double-digit sort of a growth. I think that remains the first priority. And it is not only about the top line growth, right? Ultimately, that has to translate into the profit growth and the cash flow growth. So I think that is how typically we do go about it. In terms of identifying entry barriers, try to look into because those entry barriers really, business should have some sort of an entry barrier because then only it can translate into the top line into the profits and cash flow growth. So to really look into that, we look at maybe ROI as a metrics. Historical ROI, if let's say company has been able to generate maybe within last 10 year average ROI more than cost of capital throughout the cycle. So which means business has added value to the minority shareholder, right? So that is another sort of a key aspect of it when it comes to the business selection apart from the growth side of it. Second, management evaluation is about both qualitative as well as quantitative factor goes into it. Qualitative factors are like thought leadership of the management, historical capital allocation, historically how management has gone about increasing addressable market, because that is how typically you want to size it, right? Larger is the opportunity size, longevity of the growth also do increases significantly. So looking into the management thought leadership, becomes a key sort of an important aspect. And then, then really try to look into the corporate governance side of it through various measures. Again, looking into the historical capital allocation, then looking into the board of directors, auditors, cash tax paid, historical cash flow conversion. I think some of these do remain very, very important. And then more so in case of mid and small cap companies doing a lot of primary checks, I think it is become even much more important in terms of looking into businesses. Try to interact wherever possible with different stakeholder of the company who are dealing with the company to really get first-hand sort of an experience about that. So I think these become some of the key sort of differentiators when it comes to get full hang on to the management evaluation side of it. And third is about the valuation, which is about building up longer term growth forecast for the company and then try to discount it future cash flows. So I think these three remains the key sort of a tick box or processes. When we try to evaluate business, when it comes to the portfolio construction, ideally all of those three parameters passing through company comes into the portfolio, and then that obviously is subject to the basically underlying benchmark weightages as well, particularly at a sectoral level.
Just wanted to understand what are the metrics you analyze before zeroing in the stocks in the mid cap portfolios, and how is it different from looking at the large cap stocks?
No, so typically, I think the process remains the same. The business selection side of it, then typically the management evaluation side of it. In case of mid and small cap, really maybe the ask rate for the growth might even have to be even higher, right? In case of any large cap stock, if you are satisfied with 10% sort of a growth CAGR potential, ideally the hurdle rate in case of mid and small cap, that growth rate has to be higher. Ideally 12-13% at least, because then only it is worth sort of evaluating and taking the bet on that particular space, right? So that is one. And maybe another differentiating factor could be that you have to dwell maybe a bit more deeper when it comes to the management evaluation side of it, because typically midcap now, see, over time now midcap has also evolved and have become very, very sizable. But yeah, maybe if you look into maybe in case of small cap stocks, in terms of management evaluation, I try to do a lot of primary checks. Apart from, let's say, your normal sort of a qualitative, quantitative analysis on the corporate governance side of it. It is because, see, at the end of the day, in case of mid and small cap stocks, you are taking too much bet onto the particular management individual who is really steering the organization, right? So really to get more comfort around the management thought leadership side of it becomes even more important criteria when it comes to the really selecting mid and small cap stocks. So that is maybe much more sort of a additional labor. But apart from that, see, when it comes to the business evaluation or maybe overall stock selection philosophy, I think that pretty much remains the same, which I spoken about. Business selection, starts with business selection, management evaluation, and then third, the valuation side of it. And sorry, on this management side of it, when I talked about primary checks, it is more about, I think a lot of groundwork also being involved, in this. Wherever you get an opportunity, try to meet different stakeholder of the businesses and then try to sort of a cross check around that, and then try to get much more nuances of business as well as the management out there. And then third is the valuation, right? So it is all about discounting of future cash flows, right, to arrive at intrinsic value of the business. So typically try to look into the discounted cash flow sort of a methodology to really value any particular business. So yeah.
Ankit, you rightly mentioned, while looking at the small cap stocks, the promoter is very important factor. What are the and they carry the promoter risk also. So what kind of extra due diligence do you exercise when it comes to the small cap stocks? You mentioned it, but can you just elaborate your thinking on this promoter side?
Yeah, no. So see, it is about one, let's say, on the historical number will in itself will throw quite a lot of picture, right? I mean, so one is, let's say, quantitative side of it, and second is the qualitative side of it. Quantitative, you can try to evaluate through the numbers itself. You just try to scan through last 10 years sort of a numbers, comparison, some of the, let's say, cash flow conversion metrics, your historical ROIs. And I mean, I think some of these things, let's say cash tax paid, I mean, every year, some of these things, I mean, can really throw the some sort of a basic hygiene factor about the business, right? So that is one side of it. And second, you try to look into, let's say, their auditors, board of directors. I mean, I think some of those side also, I mean, I think becomes very, very important. And then, as I mentioned, that lot of sort of primary checks, right? Which is about, suppose in a manufacturing company, if you to get hold of, let's say, meeting with any supplier who is supplying to that company. So that can give a lot of insights about, about the company, their policies, their payment cycle, their inventory holding period, dealings through, let's say, I mean, different ways and means in case if there is any sort of red flags out there. So I think these are typically, remains then obviously the promoter shareholding over time, promoter pledge, and I mean, there are so many other factors out there. Yeah.
But do you also meet the promoters in the small cap side frequently and zero in the stocks before do you meet them before buying in the stocks?
Yeah, 100%. Yes. I mean, in case of small cap stocks, yes. Though see, I mean, typically these days, I mean, even smallest of the small cap company also do host quarterly con calls, very detailed presentations out there. So I think in terms of data disclosures, I mean, I think there is enough and more to do the research work. I mean, from the publicly available information, right? So I will say that, I mean, I think quite a lot of work can be done even without meeting also. But having said that, I mean, clearly taking any big call at the end of the day, a person who is running the show get a lot more comfort around, let's say, talking to the management, even, let's say, visiting their plants, and then, and even, let's say, try to meet the second line of management. I mean, below the promoter who may be owner of the business. So I think some of these processes over time do take, let's say, more sort of a time. I mean, it is not like that everything can be do at first hand, and then, then only you will go about taking the call. But obviously, I mean, in this entire process, as and when you start getting more and more comfort, you do then try to build sort of a further position into it. Yeah.
Okay. So how do you access the growth potential and the competitive advantage of a mid cap or a small cap company, and when and what kind of stock becomes a compelling buy for you?
So see, I mean, one is the sort of a set template around, right? I mean, which is about, and there is no sort of a, I mean, I will say, nothing differentiating factor, I mean, in that process, right? I mean, if you try to look into the growth potential, I mean, longer term, I mean, 12-13% growth CAGR, and then try to look into best ROI, maybe 15% plus, and all. So some of these are like the sort of a set templates, I mean, you have to follow. But then obviously, I mean, I think some of these things will be available at its own price, right? Because market is now maybe, I mean, in basically many of the well-known sort of a stories is sort of a reasonably valued. But really, I mean, I think the key element and conviction, try to build in conviction comes in where whereas, let's say, any company, let's say, going under temporary sort of a rough phase, maybe because of maybe industry itself might not be doing good because of, let's say, suppose very high inflation, consumer sentiments are adverse, so temporarily, I mean, let's say company volume growth might not be good, right? But historical, there has been good sort of a track record. You are having confidence onto the management. So try to work around into some of these sort of a sector industries where there is quite a lot of disbelief about next 1 year sort of earning projection. But then you believe that, let's say, some of these factors has to turn it around. I mean, company is pretty well capable to really, ride through that particular cycle, and earnings can rebound very, very swiftly. So I think so. Our idea always remains that apart from the set sort of a template, try to have a good exposure around, I think, companies or businesses where, let's say, there is some sort of a disbelief around, but then disbelief plus growth, right? I mean, whenever the things might be bad, maybe because of one, let's say, top down industry growth itself might be a challenge. Second could be, let's say, there might be temporary sort of a margin pressure might be there into the company. Maybe that happens in case of maybe more like manufacturing companies or maybe commodity companies or maybe even consumer companies also, right? You might not be able to pass on the pricing,
Yeah.
right? And then the third thing could be, let's say, there might be company specific issues. There might be some management change, or maybe company might have gone through rough phase in terms of execution and all that. So some of these areas, is where typically, you would like to spend more and more time around to really identify some of the factors which can really turn it around over the course, and what could be those factors are, try to work around there, and then try to arrive at an sort of intrinsic value of the business. So in this entire process, while trying to arrive at a value, do some sort of a sensitivity or maybe scenario analysis, and then that will give you much more comfort whether the ask rate is what, right? Currently, so I think this is another bucket, when it comes to the let's say overall portfolio construction side of it. So I think second bucket is where typically, also do spend, a good amount of time to really being able to identify companies. Yeah.
If I'm not mistaken, it's more of a contra kind of play rather than pure value.
Yeah, you can say, one is the, let's say, contra side of it, and second, even, let's say, pure value as well. Let's say, in case if many of the businesses, if there is a, let's say, business sellout value might be higher than current market cap. So that might be a pure deep in value businesses. But see, another thing to remember while taking call in the second bucket, which you might say, let's say, contra or participating deep in value businesses, is also about not to fall in trap of value trap, right? So it is bit of a double-edged sword also, right? So one thing to avoid that sort of a trap, you have to be very, very comfortable about the business longer term growth potential, the inherent growth drivers for that particular industry in which the company is catering to, and second, reasonable confidence onto the management, as well, right?
Correct. Now, the fund house has been an outlier in terms of having exposure to e-commerce companies in the last 2 years specifically. So why are you so upbeat on the new age companies?
So it is again about, I think, most of these businesses fitting into our investment framework of business. Again, going back to business selection side of it, again, I think long runway for growth. Many of these businesses, whichever segment they are participating, I think addressable market is huge. And many of these businesses are market leader in their respective subsegments with proven track record, proven business model, and I think very, very long runway for growth, right? And being market leader itself is an entry barrier, right? And in basically many of these segments, you look into food delivery space, two-player market, you look into e-commerce, space. Again, I think lines sort of a market share. So many of these businesses have got very strong entry barrier in that sense, the scale which they have achieved, and plus on top of that, they are sitting on a pretty good balance sheet because they might have raised the capital in a very, very timely manner. So to that extent, I think is sitting with a very strong cash on the balance sheet. That also acts as an entry barrier when many of their competitors are struggling to raise cash, right, in the private market. So this is about the business selection. Second, again, management evaluation. You try to look into many of these businesses are, again, I think, backed by very strong, strong founders with I think impeccable track record. Many of them are technocrats with very strong board of directors, corporate governance side of it. Again, I think thought leadership wise, I think many of these things do really stand out. And then third, coming on to the valuation, that becomes a quite tricky piece. When it comes to really value some of these businesses, because clearly, I think at least on reported basis, many of these companies are not profitable. But then you have to further sort of bifurcate that into their ability to generate cash flows, and which is any which way. I think many of these companies have already shown that particular traits, right? They have already started becoming profitable. And as and when scale goes up, and then try to do sensitivity analysis around there, and then try to look into the discounted cash flow sort of evaluations, right? So I think most of these businesses were fitting in perfectly in our sort of evaluation framework. And that is how I think, we have been quite positive about this particular space, and more so for, let's say, last 1.5 year. At least 1 year also. Yeah.
You mentioned profitability, but when it comes to e-commerce companies like Nykaa, Delivery, they're far from making any profit. So does it not scare you?
So one is about the reported P&L, right? So there are two, three things are there. That is why I said that you have to dwell a bit more deeper rather than the reported numbers. One is reported P&L do include quite a lot of non-cash item like ESOP charges and all, and that is why I think, profitability wise, it comes into quite a bit of a negative number. So one, you have to adjust that, because that is a non-cash item that is not going out from the pocket of the company, because you have already counted those ESOPs in terms of fully diluted, number of shares, right? When arriving at earnings per share or cash flow per share or book value per share, right? So that is one. Second, see, many of these businesses are continuously increasing their addressable market, right? So in that process, while let's say their core segment might already be profitable, but some part of that cash flow is really going to seed some of the newer businesses within the organization, right? So to that extent, I think if you really try to bifurcate, the business into these two buckets, one is the core sort of a business which has been established, that is how the company has started, that is already generating cash flow, and then try to forecast growth prospect for that particular segment separately, try to do value of that, because the point remains that if you are not going to seed something else, then then clearly your addressable market longevity of the growth might also get compromised. So in that process, really, is it fair to penalize doubly on both these counts? So what my point is that rather than going into the reported P&L, which will show you the negative picture, in terms of the reported number, you have to dwell a bit more deeper to do some of these sort of analysis here.
Ankit, just wanted to understand, talking about the e-commerce companies, we have seen one of the, logistics company you have bought in the last 3 to 4 months. And there has been a market leader in that particular category, like Blue Dart compared to Delivery. Just wanted to understand what is the reason, because, at one side we have Blue Dart, which is an established business, profitable business, and on the other side, Delivery, which is loss making, burning cash.
Yeah, no, so see, it is all about looking into the, business holistically, trying to look into their unit economics, trying to look into how the operating leverage can play out, how is the longer runway for growth. Here, if we're trying to compare, let's try to compare the growth side of it. Last 3, 4, 5 year growth CAGR will, in itself, will be, I think, hugely different between the two names, which you have mentioned just now. Similarly, I think given the positioning, I think even the growth going forward also has to be quite a lot of differential, right? Because one is the sheer scale within the e-commerce space itself. The let's say third-party logistic market leader player versus the other name which you mentioned, there is a difference of at least 1/6. In terms of the number of volumes, parcels they are catering to. And in this sort of a business, I think scale becomes a very significant entry barrier, because that is how the operating leverage really to play out. So even let's say in an environment when top down things has been bit slow, right? Because of maybe very heavy inflation, high base of COVID and all. Companies have significantly improved their cost structure. So even with, let's say, relatively lower volume growth and all, also, I think profitability has consistently sort of improving. So I think so one has to really look into more holistically and then try to look into what is the business growth potential of that particular company and what could be the eventual, let's say, ROI, ROCs in the future, right? Because one is more like asset heavy model, one is more like asset light sort of a model. So I think one has to keep into mind too many things around and try to really look into maybe 3-5 years sort of a picture to do justice or let's say to try to arrive at a value of the business. Yeah.
So do you foresee the ROC and ROE of this companies improving over the next 3 to 5 years?
Yeah, 100% yes.
Okay. Ankit, another thing was, recently you have just started managing the Mirae Asset Multicap Fund. Given the current rich valuation in the market, which pockets of the market attracts you the most, and how do you plan to allocate that money?
Yeah, no, absolutely. I think you're right. Markets are quite euphoric, more so mid and small cap segment. We have been seeing quite a lot of euphoria getting built in out there. I mean, the underlying earnings momentums are great. Macros are favorable. Micros are also too much supportive, much more structural case around given the government policy incentivization. And then I think quite a lot of things sectors are playing their own part. And some of those could be structural in nature also. So market is rewarding. I mean, I think some of these things may be a bit more front loaded. So clearly, I mean, I think on let's say 1 year forward earnings and all, market will always look expensive and more so in mid and small cap bucket. So as things stand today, our even let's say within multi-cap product you talked about, our preference remains more towards let's say large cap at this point of a time. So we have leeway to invest up to let's say 45-50% into the large cap and then 25% each in mid and small cap. So I think with that sort of a thought process, we have been going about deploying the money. And in terms of sectoral allocation, I think maybe financials, consumer discretionary, pharmaceutical, new age businesses. Yeah, so some of these areas are looking quite interesting still. Still, I think there are reasonable value across some of these pockets, and that is how I mean typically we are going about deploying it. But having said that, see, we do remain, frankly, quite constructive on the market from the longer term standpoint. Try to build a pretty, I mean, always thought process remains that try to build a pretty good diversified portfolio with good sectoral representation, typically not take very heavy active sector call. So in that process, try to minimize the risk. And also portfolio should be able to withstand mistakes. So I think that remains the thought process. And with the similar sort of a thing, I mean, we are putting efforts towards building portfolio for this fund as well.
Coming back to the e-commerce and the fintech companies, just can you explain 3 to 4 important parameters, which you look forward before investing in the stocks and, how that will be changing going forward?
Let's take an example of maybe food delivery business, food delivery business as such. So let's say how many users they are catering to at this point of a time. Overall household income maybe 7-8 lakh above sort of a household income. So let's say maybe 100, maybe $10,000 and above, right? So how many households are there, right? So try to bifurcate into that particular target segment and then try to look into the penetration, right? So let's look into the maybe 400 sort of a AOV, I mean average order value, and then try to look into let's say what sort of a households can really afford it. So maybe $10,000 is a decent sort of a number to with basically disposable income. I mean basically $10,000, right? So in terms of target set, households could be more like 88 million. So top down, if you start with number of households could be more like 400 odd million, 350 to 400 odd million households. But within that, even if you try to look into maybe 20-25% of the households, which might be the target sort of a audience for, for this sort of a category, and then try to look into two players serving that, right? So both of these put together is more like 3.2 sort of a million monthly active user, right? User, right? So when I said that maybe 9 to 10 million sort of a target households, which is having disposable income more than $10,000, and within this, maybe their current reach might be more like 3.1 uh, million monthly active user. So the penetration is, let's say, more like maybe what 28, 30 odd percent at this point. And then it is more about the sort of a frequency, right? And second, number of households might also grow, right? As your per capita income goes up. So maybe more and more households will come on your $10,000 sort of a bucket. And today, let's say in terms of frequency is more like what, maybe 3.5, 4 times a year. So that sort of frequency will also go up. So if you try to do the math, try to look into monthly transacting user, multiply by frequency, that will give you the monthly sort of a order. And then try to look into the growth. So that remains one of the key sort of a thought process, which will try to give you the comfort that given the business where it is, I think maybe 20% sort of a growth CAGR is also possible. Plus on top of that, inflation driven growth, right? Because food inflation will also keep on increasing your average order value every year, at least by maybe 4-5% or so. So to that extent, I think some of these things keeping in mind, try to size the market, which can boils down onto your sort of revenue growth forecast for longer term. And then try to look into the cost side of it, unit economic side of it, right? So one is the average realization per order, which is a function of what is the take rate, the commissions you do on, plus maybe all sorts of fee, delivery fee, and all that, and then try to look into the cost side of it, every line item. So with maybe per rider, more and more number of orders, the higher is the density within the same sort of area, your unit economics really goes up. And then try to do some sort of a global comparison around, maybe those are maybe 5-7 years ahead of us in terms of overall ordering and then profitability metrics and all that. So keeping all of these things in mind, and then really try to put into the model into the future, and then try to arrive at a value. So typically, these are some of the things, where you do start top down basis, and then try to look into the intrinsic value of the business. Yeah.
So there are many factors which you look into before buying this kind of stocks. So what, according to you, are the key risks which can derail because it's the hypothesis is based completely on the future outlook and the future growth.
Quite a lot of it is to do with clearly country macro outlook also, because at the end of the day, let's say in this case example we discussed just now, quite a lot of thing it depends on to the per capita income going up, right? You are betting too much on that. Sorry, and per capita income is a function of how the country grows, right? So I think everything is linked to really macro. If macros are not supportive, company on their own do have limitation to really just save onto the cost side of it. So if top line does not fire, your margin will not come for sure, right? So I think it is all about the growth expectations which you are building in, and if companies are not able to deliver that, then clearly I think some of these things are not justified at all.
So the next question will be, then when do you sell it? Not particular these stocks, but other stocks also. So what leads to the sell decision?
So we do sell any position in three cases. One is about let's say fair value do exceed maybe our sort of a intrinsic value by a certain margin. So maybe because we have got pretty I think sector specialists out here with price targets covering different sectors, So if fair value is X and let's say stock price is 1.2X, so then obviously you try to find out if there are better alternative available within. First preference remains within the same sort of subsector. If there are better opportunities available, then try to sell it and then try to bought into something else. Second is about if you ended up making mistakes, right? Maybe genuine mistakes, maybe related to one, your forecast itself has, let's say, gone for a toss. So clearly your assessment of the value will also get fallen, right? So in that case, you have to take a call. Within this bucket, in case if any sort of a corporate governance issue to crop up, or maybe some sort of a capital allocation issues to crop up, then obviously you have to take a hard call and then, then try to sell it. And third case, you might have to sell it also because of, let's say, this every 6 month classification keeps on changing, right? From mid to large and maybe small to mid and all that. So obviously at any given point of a time, you have to maintain minimum certain percentage across each of these buckets, be it, let's say, in case of mid-cap mandate, multi-cap mandate, large and mid-cap, which is EBF mandate, which is EBF. So in that case also, really, sometimes you have to do a bit of a shuffling to be complied with the overall mandate.
Ankit, coming to the Mirae Midcap Fund, it has seen slight underperformance in the last 1 year or so. So what are the reasons for the underperformance and how are you planning to improve the performance going forward?
Yeah, no, so we have come back strongly. I think if you look into, yes, it has underperformed maybe initial 4 or 5 months of this calendar year, and now, I think last 3 months, it has recovered pretty. Pretty sharply. So because the reason for underperformance was maybe we might be a bit early in taking overweight stance in, let's say, some of the sectors like pharma, consumer discretionary, and all, which has now really started playing out in last 3 months or so. So now, if you look into even on 1 year basis, I think it is quite comfortable, maybe median. In terms of peer returns, and obviously since inception, I think is a quartile one for sure. So so see, clearly in case of mid caps, any business you are trying to buying in and all, at least 3 years sort of a thought process you to try to buy it. Sometimes your thesis to play out and all, might take maybe 1 year, 6 months. And so to that extent, I think really, coming into the mid-cap mandate, it will come with its own set of volatility, both in terms of returns as well as the performance. But see, our idea always remains to build diversified portfolio across different sectors, so that maybe across the cycle you are able to perform.
Looking at the Mirae Midcap portfolio, there are many PSU stocks found in the portfolio. So what are the reasons for opting for the PSU stocks in the midcap fund?
So PSU names, whichever we are owning, that is on the merit of the business. So I think if you look into many of the names, one is on the merit of the business, and second, of course, the valuation side of it. So as I mentioned, that thought process remains that to build portfolio with a good mix of growth as well as value. And within PSU stocks also, whichever we are owning, I think many of them are, having a pretty decent sort of a track. Track record with decent sort of entry barrier. In maybe some of the cases might be monopoly also. So I think any business coming into the portfolio has to be on merit of it and on basis of absolute risk reward on that particular name, be it PSU, private. We are not sort of a we are not sort of a paint companies ki bhai, this is PSU, so we will not invest in. It is all about absolute risk reward on any particular name, and then that is how it will come into the portfolio.
All right, just a couple more questions before we wrap up. So within the last 2-3 years, Indian equity markets have seen a sharp fall. and a euphoric rise thereafter. So can you please share which investment decision of yours during this period are you really proud of?
No, so there are no, so generally people do discuss. Only the maybe the winners only. The success rate or maybe hit rate till now has been good because clearly the sort of process we have laid out. Try to avoid which helped us try to avoid mistakes. But having said that, yeah, there might be many of them, but without, let's say, going into individual name and all, they might be there. Let's say onto the public domain. So see, maybe one name, let's say within auto space, the name which we picked up within the two-wheeler space, might be underdog at that point of a time, having sort of a lower market share. But then, and this decision might be taken, let's say, maybe what, 4.5 years back. And since then, maybe stock might be 5x. So, so clearly, I think it is all about, again, so this again comes into the second bucket side of it, right? The entire street, everyone was too much short-sighted, focusing on to the near-term margin picture for that company, that margins are not improving, companies having subpar margin, one company is making 5%, the other incumbent leaders are at 15, high teens sort of a margin. But then really, our sort of a thought process on that company has been that management is pretty much ahead in the game when it comes to the investing in the product, brand, technology, futuristic technologies, and which will obviously, the expenses are front loaded, right? Because you are investing for, let's say, next 10, 20 years sort of a time horizon. And that is why your current margins are suppressed, right? But as and when some of those things do see light of the day, right, in terms of launches, and then your market share picking up, volumes getting built up and all, and that is how typically the operating leverage is going to play out. And plus on top of that, even 4 or 5 years back, we were having some sort of a view around electric vehicle and all that is going to come up. And then clearly, we'll see a significant sort of a, built up, right? So any company which is investing ahead of time to some of these technologies, are eventually going to get winner, or at least not going to get disrupted. Even if, let's say, there are new player has to enter through, let's say, with this newer technology. And that is how exactly the things have been playing out, right? So typically, I think sometimes it takes maybe more holistic sort of an approach while really understanding nuances of the businesses. Rather than just getting bogged down too much by the maybe P&L side of it, near-term profitability, near-term growth, market share side of it. So I think that remains in many of the cases, and while evaluating businesses, and that is how typically we do try to identify companies. Yeah.
Lastly, Ankit, any regrets for any investment decision in the past?
No, not really. I think God has been very kind. I will say so, and even markets are very kind. So even if, let's say, you ended up making any sort of a mistakes, as far as mistake is not very big, right? You can hide that particular thing with so many other, sort of a things, right? So, and any which way, I think if you take 10 calls, if your hit rate is maybe 7, 8, higher is better, obviously, but 7, 8 also out of 10 is a decent sort of a hit rate. Yeah.
All right. On that note, time for us to wrap up this chat. Thank you, Ankit, for joining us and answering these questions.
Okay. Thanks a lot, team, for giving me this opportunity. Yeah. Thanks a lot.
Thank you.
Okay. Bye.